Good afternoon, ladies and gentlemen. Welcome to join us today at the Credit webinar. My name is Simon, the Managing Director of DMI. Maybe some of you guys have heard about DMI. DMI is a professional cross-market fixed income data provider. We aim to improve the transparency and the liquidity of Chinese fixed income assets with our unique data so that we hope that the investors globally embrace the Chinese fixed income assets. With us today, I'm honored to introduce our speaker, Mr. Stanley Cai, the Managing Director of Financial Institutions Rating at Hongyuan International, a global credit rating agency helps offshore investors know more in depth about China. I have a few reminder for the conference. Today's webinar would be recorded. The presentation playback will be available on the website of Hongyuan International afterwards. Lastly, for any participants required assistance anytime, please send a message to the host through the chat section on your right-hand side so that we can see. And after the main presentation, we would open the Q&A section for the audience. You can type in your question on the Q&A section on the right side. Now I am heading over to Stanley Cai. Hi, Stanley. Could you start when you are ready?
Yeah, thank you, Simon. Good afternoon, everyone, and good morning to those of you dialing in from other parts of the world. Thank you very much for participating in today's webinar. We're obviously going through a very challenging economic climate globally and domestically, and we wanted to take this opportunity to give you an update on our views on the Chinese banking sector. To begin, we thought it would be useful to look at the bigger picture. Now, the chart that you see here plots the bank's 5-year average CET1 ratio against their returns on equity. What it's really meant to show is the trade-off between shareholder and bondholder interests. Where you would want to be on this chart is the upper right-hand corner. I suppose one of the first points that I would like to make is banking at its very core is a balance sheet management business. And understanding what drives the bank's capital management decisions is an important part of our rating process and what we do on a daily basis. Just to give you an example of what drives capital management decisions, some of the more mature financial institutions that I've had experience with make it very explicit that their goal is to optimize and not maximize their credit ratings. Some of them will say, for example, that they don't need a single A rating because they believe a triple B rating represents the best trade-off between the financing costs on the one hand and shareholder returns on the other. So how do the Chinese banks stack up based on their CET1 ratio and ROE? First, we look at the 6 state-owned mega banks. If you look at the x-axis, their ROEs in the last 5 years all fall into the 10 to 15% category. Now, as ROEs have obviously been under a lot of pressure, and we believe it's likely that they will continue to come down in the next 12 to 24 months. And that's due to both the pre-provision line and also the extra provisioning that they will have to make due to the current economic environment. So these red dots that you see here are likely to shift to the left when we next revisit this chart. On the y-axis, which shows their CET1 ratio, the discrepancy is quite a bit wider, with CCB on the upper end and Postal Savings Bank at the bottom. Now, what about the joint stock banks? I'm sure most of you are aware CMB has always delivered the highest ROEs amongst its peers, partially due to what they describe as a more asset-light business model. What's more interesting, though, is that the other joint stock banks, CEB, CITIC, Ping An Bank, Minsheng, Industrial Bank, and SPDB, all form a close cluster near the bottom of the chart. Again, I think the most likely scenario is for this cluster to move towards the left and possibly marginally to the bottom when you get around to updating the chart next time. And just to give you a more complete picture. We've included here a number of the largest banks in the world. I think that the thing to note here is that the US banks have done significantly better than the European banks since the 2008 financial crisis. But with the exception of JP Morgan, most of the larger banks in the world have been reporting ROEs in the mid to high single digits. And again, I believe that given today's economic environment, the pressure will continue to be there. Now, all the way to the left of the chart is Deutsche Bank, as it continues to restructure its capital market businesses and unwinds its off-balance sheet derivative positions. The final comment that I would like to make with regards to this slide is that these two ratios are obviously not the only indicators that we look at in a global rating criteria. And there are a number of key concerns we have when it comes to Chinese banks that may put their ratings in a significantly different order than their positions in this chart might suggest otherwise. And just to continue with the international perspective, this slide shows the list of all the global systemically important banks as of 2019. So as you all know, following the 2008 financial crisis, the Financial Stability Board was set up to promote regulatory reforms. One of the things that they've done since then is to publish a list of G-SIBs every November. And this list was last updated in November of 2019. And following the last review, there were basically only two changes in the list. Deutsche Bank went from bucket 3 to bucket 2 for obvious reasons, and the Toronto Dominion Bank was included in the list for the first time. Obviously, ICBC, CCB, ABC, BOC being the four largest banks in the world are on the list. ICBC and BOC are in bucket 2 with a 1.5% capital surcharge. CCB and ABC are in bucket 1 with a 1% capital surcharge. Now, so how is this all relevant to our ratings? First of all, the FSB criteria provide useful inputs on the bank's standalone profiles. And the G-SIB reporting requirements cover a much bigger subset of banks in the world than what you see here on the list. They require all the banks that have more than 200 billion euro in assets to report every year based on their criteria, which cover their asset size, interconnectedness, which is measured by their interbank balances, substitutability, which measures things like cross-border transactions, and complexity, which measures their exposures to assets without actively traded markets. So looking at how the largest Chinese banks measure up based on these metrics is very informative. You'll notice how, for example, even though BOC is a bit smaller than CCB in terms of asset size, it's actually put in a higher category. The main reason is that BOC scores much higher in terms of handling cross-border transactions. What is more interesting, though, is if you look at the G-SIB reporting of the Chinese joint stock banks and the few city commercial banks that have to follow the reporting requirements, is the fact that they scored disproportionately high on the interbank liabilities, on the custodian assets, over-the-counter derivatives, and liquid security holdings. What this suggests to us is that although individually, they may be insignificant in terms of size. They collectively pose very significant risks to the Chinese financial system as a whole. And this factors into our rating criteria as well. What this does is it allows us to distinguish the sources of potential support. So rather than thinking about quote-unquote government support in a generic context, we differentiate direct government support to the SOE banks from potential support due to each bank's systemic importance. So I think this analysis provides investors with an extra layer of information, and I think this is also what differentiates us from the other international credit rating agencies. And again, I think when we talk about the Chinese banks, very often international perspective is very important. So what this chart shows is from 2001 and 2020, there were an average of 28 bank failures in the US. So far, as you know, we've only had 3 in China. Obviously, the US data are skewed by the financial crisis and the years following that. But say in a normal year, the number of bank failures is in the mid-single digits. And since the beginning of COVID-19, we've seen 2 banks fail in the US. The First State Bank with $152 million in assets, and Ericsson State Bank with $95 million in assets. So the bank failures since COVID-19 have been manageable in terms of the size. But what we're also seeing in the market right now is a significant pickup in delinquency rates across the board. For instance, if you look at the US commercial mortgage market, delinquency rates have already tripled year on year. And that alone is a $1.3 trillion problem. And I would not be surprised if bank failures continue to pick up as we go into the third and fourth quarters. But in terms of the quantum, the amount of assets that are at risk, I think we are still quite a bit of way from what we saw during the financial crisis. What about Europe? I think more than in the US, the European economy depends on banks to function. European companies get more than 2/3 of their credit in the form of bank loans, while American firms get less than 1/3 directly from the banks. Since COVID-19, there have been no bank failures yet, and that's largely in part because of what the European Central Bank has done in terms of flooding the financial system with cash. But the problem to us is certainly worrying because many banks there never really had a chance to recover since the last financial crisis. And Deutsche Bank, I think, is clearly a good example of that. And the European banks have been struggling well before COVID-19, and there's really no way for them to recover their earnings capacity when interest rates stay negative or close to zero. Okay, the situation in China is obviously very different. We've seen 3 bank failures so far. Baoshan Bank and Heng Feng have been effectively nationalized. The Bank of Jinzhou was rescued by the state-owned strategic investors, including ICBC, and the 2 AMCs, Cinda and Great Wall. I think the international investors' concerns, particularly with regards to the resolution of the Baoshan bank situation, is the regulator's stance with regards to bail-ins and bailouts. So now conceptually, the Baoshan case opened up a new method of bank resolution where institutional investors could be made to take a loss without the bank going through an actual bankruptcy or a formal resolution regime. Now, I think this year overall is going to be a very tough year for us bank analysts with the various measures to relax lending standards, including loan forbearances and the relaxation of loan classifications. We may not really be able to see how bad things are in the next few reporting seasons. So as part of the work that we've been doing on GSIBs and DSIBs, we've developed an internal tool to assess the amount of capital shortfall that the equity market expects. So with the S-risk model that you see here, what we do is combine financial statement data and daily stock prices to arrive at an estimate of what at least the equity investors believe the potential capital shortfalls in the market are. We are also able to see each individual bank's contribution to systemic risks as perceived by the market. So the sample we use here includes all the listed SOE banks, the joint stock banks, and a small number of city commercial banks. And as you can see in the chart, up until the last time we updated the model, the perceived capital market shortfall was around 5 trillion RMB. Obviously, this model is not part of our rating process, but at least as far as equity investors are concerned, the NPL ratios at these banks are much closer to 10% than 2%, which I think is an interesting reference point. Okay, so what's our current view of the financial system as a whole? I think the key message we want to get across today, and I think it applies to many other corporate sectors we cover as well, is the fact that there's going to be continued divergence in credit profiles across the board. ROAs and ROEs at these banks will likely fall, but I think the key stress points are in the rural commercial banks and cooperatives. We believe the large commercial banks and most joint stock banks are still going to perform within our expectations, perhaps with a small number of cases where capital may be a concern going forward. One other point we would like to make is we look forward to seeing more clarity with regards to these SIP surcharges. depending on the shape and form of the final implementation schedule and the amount of capital surcharges that the regulators will impose, it's likely that some of the smaller joint stock banks will need more common equity if they are considered to be a domestic, systemically important bank. So going back to this chart, although the rural commercial banks and cooperatives are small individually, they collectively make up a fairly significant part of the financial system. At this stage, we are certainly not expecting a major systemic event in this particular subset of the sector, but a large part of that will ultimately depend on liquidity situation. Many of you will remember the situation back in 2010, where 3 rural commercial banks effectively defaulted in the interbank. Each default was only for a small amount in the order of tens of millions of RMB, but these liquidity events tend to be worrying as we continue to work through the current economic situation. Okay, so overall, we think the policy responses to the current situation have been largely effective and tailored to specific parts of the real economy. These include things like lower lending rates, loan forbearances and grace periods, policy tilt towards SMEs, and more relaxed policies towards the banking sector. Now, at Pengyue International, we have conducted a very thorough review of the corporate sectors we cover. And the consistent analytical conclusions we have arrived at is that policy support to various industries will significantly soften the blow to the corporates we cover. But I suppose the key question that international investors have with regards to the banking sector is that something's got to give. Someone has to take up the burden to shore up the corporates and households. How big of an impact would that be on the banking sector? So international investor concern number one, very obvious question, what is the impact of lower lending rates on bank profitability? Overall, we believe the regulators have taken meaningful measures to facilitate lending to corporates, with the loan prime rate coming down by about 50 basis points over the past year. And the regulators re-emphasizing that the deposit rate is the anchor of the financial system and it will not be touched. The lower prime rate would mean narrower net interest margins for the banks, of course, but I think the impact remains manageable and pre-provision profits are still going to support capital formation. Among the banks that we've looked at, the earnings impact for the year is probably going to be in the order of low to high single-digit percentages. So it's going to be an earnings concern, but not necessarily a balance sheet problem. The second issue is a lot more worrying, though, in our view. And this is the reason why I said earlier that this will be a very tough year for bank analysts. What is the impact of loan forbearances? So I guess the key question here is, are special mention loans in China effectively equivalent to NPLs eventually? If you just look at the provision coverage ratios, most of the large commercial banks and joint stock banks can meet close to a 3% NPL ratio. This may appear relatively conservative compared to some periods in the past, but I think special mention loans are going to pick up noticeably this year. The banks themselves are guiding for higher NPLs in the order of around 25 basis points on average. But I think special mention loans are going to go up much faster than that. One area we pay especially close attention to is the migration rate of special mention loans to NPLs over any given 12-month period. Among the banks that we've looked at, the migration rates range from 15 to over 30% over 12 months. So to us, what that indicates is really a significant under-recognition of NPLs initially. Now, so what's the correct theoretical migration rate, or what's the migration rate that regulators would be comfortable with? If you look at what when the CBIRC first issued its capital management rules, the indicative special mention loan migration rate was in the mid-single digits. So obviously they eventually decided to take that out of the supervisory indicators, but that sort of gives you a sense of where things should be. Now, the banks won't report migration rates again until the end of the year, but if special mention loans start to pick up significantly when they next report, we'll have to monitor the situation quite carefully. The third question is related to micro or inclusive finance. So what is the impact of these new micro loans on the bank's balance sheet? So micro, or the smaller subset of inclusive finance, has become a top priority for the regulators. And this is one of the reasons, I suppose, we believe there will continue to be a divergence in credit profiles between the bigger and the smaller banks. Overall, microloans are now about a quarter of the industry's loan book. Although that may not seem to be that significant, the bank's exposures do differ, with the joint stock banks, city commercial and rural commercial banks having higher exposures in percentage points. Now, from a policy standpoint, SMEs account for 60% of China's GDP, and their survival is obviously very critical to the economy. But the vast majority of them only have cash to burn for 1 to 2 months. So many of these loans would have been considered special mention loans or NPLs in the last few months. And also, I think more importantly, and this is something perhaps investors haven't really paid that much attention to, is IFRS 9. So in the spirit of IFRS 9, the banks will have to provision for many of these loans on an expected value basis. And if you look at what the regulators have repeatedly said, the previous tolerance level for the NPL ratios of microloans is 300 basis points above the bank's overall NPL ratio. The actual reported numbers we've seen range from 1.5% to 3.5% for these loans. But if they were properly accounted for, the smaller banks will have to take a fairly substantial hit to their capital. And finally, international investors have been asking, we know the economic shock is significant. We know that drastic regulatory measures are required, but are long-term financial reforms still on track? Our short answer to that question is that we think that various financial reforms that the regulators want to implement will remain in place in the longer term, but in the shorter term, 2020, 2021, I think the focus will be to get the economy back on track. And what we've done here is we've used WMP reforms as an example of a type of regulatory reform that will continue to happen, but will be pushed back by another 12 to 24 months. Overall, we anticipate that the regulators will continue to take a accommodative approach in pushing through reforms in the WMP market. This will, I think, particularly give the joint stock banks a much needed buffer in a very difficult operating environment. So just as a reminder, the new regulations were originally targeted for full implementation by the end of this year. And these rules call for fundamental changes in the way WMPs are designed, in how they're sold, and in how they're priced. So although the banks have made significant progress in improving the market structure since 2018, we think there are still a few hurdles. Number one, the joint stock banks are major distributors of WMPs. We believe it would be unlikely for most of them to meet the initial regulatory deadline, especially as fundamentals remain weak. The joint stock banks manage over 40% of AUM in the WMP market. And if we were to push through the new rules in 2020, it will affect them in three critical ways. Number one, commission income may come under substantial pressure. So under the new regulations, products are required to be priced on a net asset value or NAV basis and do not offer an explicit expected return. This makes WMPs much less attractive to the average retail investor. Second, the banks may not have adequate management resources to comply with the new sales, investment, and reporting requirements. And finally, existing assets that do not meet the new framework may have to be brought back onto their balance sheet. This will affect the bank's required reserves, asset provisions, and ultimately, I think, capital positions. And other key hurdles include conversion to NAV pricing and treatment of illiquid non-standard credit assets. As of now, only 35% of WMPs are NAV based. The banks have made some progress towards migrating to NAV product designs, but retail investor pushback and the lack of secondary market pricing for many asset classes continue to make full conversion difficult. So we think it may take another year or 2 years before NAV-based products account for the majority of sales. And also, on top of that, non-standard credit assets, which account for about 17% of AUM, present challenges in areas such as asset liability management. Although many of these non-standard credit assets are in runoff and may not be wrapped into new product structures as they mature, the remaining duration is still significantly longer than the WMP's investment horizons. So this essentially creates a huge asset liability duration mismatch that the banks have to continue to manage. But on a more positive note, industry practices, market infrastructure have come a long way since the early days of WMPs. 16 banks have set up wealth management subsidiaries. So this covers a large subset of the industry. And also with a more established trustee structure, these dedicated WMP business units offer a much higher degree of ring fencing from the bank's actual on-balance sheet assets and deposits. And you would also know that capital or return guarantees on WMPs are now prohibited. Existing products are being run off or converted into on-balance sheet structured or plain vanilla deposits. Also, another area that I think has improved a lot is with the interbank WMPs, which used to account for 25% of the AUM at the peak in 2016, but it's come down to about 5% of outstanding AUM now. So all of these factors, I think, have contributed to a more prudent operating environment. So this is an example of a regulatory reform that is still ongoing to an extent, but the ultimate implementation deadline has been pushed back another 12 to 24 months. And I think that's going to happen with a number of other financial reforms that the regulators have in mind as well. So that concludes my presentation for today, and we can open up the floor for questions. And Simon, if you could help to manage the Q&A.
Yes, thank you. Thanks for Stanley for the clear image of the banking and the credit conditions in China. Obviously, we are faced up with a more volatile environment. Well, I have two questions for you from our guest. The first question is, how will the banks do this year in the People's Bank of China's stress test, and how many of them will fail? Question one, and we have another question. Will the banks cut dividends this year? What do you think, Stanley?
Okay, thank you, Simon. So the first question has to do with the stress test. I think there was quite a lot of market chatter about that in the last month or two. And most of you will remember that in last year's test, and that was before COVID-19, half of the largest banks will essentially need more capital if GDP falls to around 4.5%. Obviously, we're going to fall well below that this year. However, when you look at these stress test scenario, I think it's important to remember that the path the scenario takes matters a lot as well. And policy responses to soften the blow to the corporate sectors will mitigate a good portion of that shock, in my opinion. In any case, I think the regulator's priority right now is to adopt countercyclical measures to support the bank's continued lending. And in our base case scenario, it's likely that the large commercial banks and the vast majority of joint stock banks will come out of this year marginally weaker. But I think it will be unlikely that we will see significant systemic risks that would affect the entire banking system. And the second question has to do with dividends. So, a lot of the US and European banks have had to cut dividends, share buybacks, and capital repatriations. Obviously, those of us in Hong Kong know that the most high-profile case recently has been HSBC, which faced massive pushbacks from the investors. However, right before COVID-19, the Ministry of Finance actually issued a statement asking specifically the SOE banks to scale back their loan loss provisions and increase their dividend payouts. So overall, I don't believe that the large state-owned commercial banks will cut dividends this year, but we may see select cases within the joint stock and city commercial bank universe.
Thank you, Stanley. Due to the limit of time, let's take one more question from the floor. Let me see. There's one more. When will we see another bank failure? What should we watch out for, Stanley?
Yeah. So as I said before, I think it's unlikely that we'll see a large bank failure anytime soon. But things start to get a little bit more worrying as we go down the list of rural banks. All three bank failures that we've seen so far has some corporate governance elements in them. And I would certainly be worried if you're invested in banks that postpone their financial reporting, for instance. But overall, I would watch out for number one, liquidity for banks that rely heavily on wholesale funding. And number two, banks that report a significant deterioration in special mention loans, and especially migration rates as we go through the fourth quarter.
Okay. Thank you. We have a really wonderful time here, and thank you one more time, Stanley, for the informative presentation and the response to the floor. Well, I think if any one of you have any further question from you, you can reach to Stanley via the contact information on the screen. Again, thanks everyone for joining us today. Please stay tuned to Pengyu International as well as DMI. We are all both here to help. We look forward to speaking with you guys again. And I think it's goodbye and take care, everyone.